please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, right now we are building to that 3 p.m. move. If there's any, let's just wait for that. It looks curiously placed right now at 27,027 on the Bank Nifty. Just want to keep an eye on HDFC Bank's intraday chart. That really decides that 3 p.m. move. HDFC Bank and of course to a certain extent even Kotak Mahindra Bank. Sometimes you have seen big moves in both these names. So that's something that you would want to keep an eye on. First take on Kotak is on the downside for the 3 p.m. move. On the Bank Nifty, it looks like the equilibrium of 27,000 is going to stand. So for now, 27,024 is what we have. Ashwani and Mitesh with us for BTST calls. Ashwani, you go first on index first. What would be your strategy and what about individual stocks?
See, I'm not very intelligent on expiry, but what I have a sense is that there is enough selling that's happened for the day. So now if you have to bet on one side, you should bet that the market recovers a bit. Even the Bank Nifty, we've seen IT index recover quite a bit. So given that the momentum is still up, generally speaking, the closes on such days are towards the upside, not towards the low. So that way I would possibly be buying Nifty, Bank Nifty, etc. Having said that, individual stocks, Balrampur Chini is a buy with a stop of 67, target of 75. Yes Bank is a buy with a stop of 374, target of 390. And HDFC is a buy with a stop of 1950, target of 2010.
Okay, so quite a few buy calls there on Ashwani's list. Mitesh, what would you go with? Last half an hour, carrying it to tomorrow?
Yeah, BTST and Arvind, I think, should be a good trade. I think Ashwani also mentioned the stock. We also had a buy 2-3 days back over here. It's now getting past that 410 mark. So buy with a stop below that. Look for 425 as your 1-2 day target. And STBT and Mahindra, where the intraday charts are suggesting that the breakout above the 925 range appears to have failed. So take a very tight stop at 921 and look for target around 900.
Okay, just don't lose sight of Karnataka Bank. We are awaiting numbers anytime now. Usually they declare numbers between 3 and 3:30. Last time I remember it was right when the market was closing. 120 on that stock went to the low point. From there, it's been a bit of a recovery that you have seen on the stock. So just keep an eye on this one. Rajesh Kothari, Managing Director of Alpha Accurate Advisor, is our next guest now who joins us. Rajesh, hi, good afternoon. So we have an all-time high on the Sensex today, but as we found out on our Twitter poll as well, and in general, looking at mutual fund NAVs, portfolios are still 20 to 30%, in certain cases more than that, from their highs. Your thoughts on this big dichotomy that we are seeing right now?
Well, you are right. While the Nifty and Sensex, they are at close to lifetime high. Most mid and small cap companies, if you look at the mid and small cap indices, they are 15 to 20% low from the recent peak, and many of the mid and small cap companies are down by 20 to 30 to 50%. So individual portfolio performance might vary, but yes, that's what the benchmark indices are suggesting.
Rajesh, I was going through your earlier note. I don't know if the position is still the same. At least at that time, you were saying that the focus within your PMS is to stick to more sort of bigger liquid stocks. Is that still the stance? What would the mix be, let's say, between large caps and mid and small caps in the PMS now?
So you are absolutely right. So our focus remains, we are a multi-cap PMS. So about, I would say, 40 to 45% of the portfolio is large cap as per the new SEBI definition, and the balance would be mid and small cap. And of course, we are holding 7 to 9% cash. So that would be the approximate breakup. But what is more important is that rather than looking at small cap or large cap, what is important to look at whether the size of the company is large, mid or small. So profit size of the companies are more important rather than market cap of the company. So approximately, I would say 92% of our portfolio companies have a net profit in excess of 50 crores, and approximately 45% of the portfolio companies would have net profit in excess of 500 crores, and about 30% of the portfolio companies would have net profit in excess of 100 crores. So this number is very important because size of the company is very important, particularly in an environment when the inflation is going up, interest rates are going up. So if you are a company which in a portfolio which is of a reasonable size, then the impact from such interest rate and inflation, higher inflation risk, that reduces significantly because they are able to absorb any such shocks.
Okay. In the past, you have had investments in Bharat Forge. I think you exited that. I wanted your thoughts on stocks like Motherson Sumi and the way the market is treating them. In the morning, we spoke to the management, and they said that look, it doesn't impact us at all. In fact, if anything, it will impact us positively. How do you view some of these companies now?
So you are right. So the trade war is one of the major risks which global markets are facing. And so what we have done is in a portfolio level is that the companies which have a significant exports to USA market and where there is a possibility of any trade war risk, we have reduced or exited such companies. One of the companies in the forging sector. But companies like Motherson, we continue to remain, we continue to hold this company because we believe probably the impact will be limited. But yes, the right now market is assuming that there is going to be a big impact because if the US imposes trade barriers with the European countries and Motherson having a large presence in Europe, and if any of that company's exports in turn to US, then it may get an impacted. So we are not too sure what kind of impact it will have ultimately in the medium to long term. So we continue to own the company and we believe that earnings growth is going to be very strong.
Okay. So Rajesh, what else have you picked up in the mid-cap fall? Because a lot of stocks have come off 20, 30, 40%. What is it that you like? If you can share one or two names, that will be great. Otherwise, at least some ideas, some themes.
So we continue to like auto ancillary as a theme, and we have invested further into auto ancillary as a segment. A few companies which we already used to own, but after a significant stock price appreciation, we decided then not to buy further. Now they are already available again at 20 to 30% low from their recent peaks. So we are adding that name. Few of the companies into specialty chemical segment we have added very recently. Again, these companies are that fits into our 3M investment approach: market size, market share, and margin of safety. These companies are leadership player in the specialty chemical segment with a debt-free balance sheet, with a 20% return on net worth, 20% return on capital employed, and they are trading at around 12 to 15 times price to earning multiple, forward multiple, depending upon which year you take, FY19 or FY20. So there are interesting, names which are emerging. One of the other company which we added is into the optic fiber, so is the only company which is into that space. So you can have a huge data explosion and is the largest beneficiary of that space. That company is also corrected quite a bit, so we have added it further. These are the few names which we have added. So our concentration remains, our focus remains on the companies with a very strong market share, and I would say undisputed kind of a market leadership, very high quality of earnings growth, very strong balance sheet, kind of a
Just hold that thought, Rajesh. I just want to address Karnataka Bank's numbers. And that number looks good, actually, because the net profit is 163 crore versus 134 crores. And what is really good is that the gross NPA has actually come down, 4.72% versus 4.92% quarter on quarter. So I think the market would like that. Because, last quarter there was indication that perhaps you've seen the worst of asset quality play out. Yeah. I think this time could be the first indicator. There has to be follow through, of course. But I think based on these numbers and the fact that there were shorts in the system on Karnataka Bank, I think that's the reason that you've seen this kind of move.
That's a huge move. Also, Anuj, I would think, we must put out the provisioning numbers as well. Because remember, recognition might be over, but there was still always this confusion with the Feb 12 circular that will provisioning continue to be elevated. That's not the case. Provisions have gone down dramatically for Karnataka Bank. They have come down to just about 222 crores from 540 crores in the March quarter. So that's at least sequentially, there's been no hit on the P&L because of higher provisions. And I think the market is taking it with both hands, Anuj, at the moment.
Yeah, it's just that right now it's not a good market for mid-caps. But otherwise, I think this is not a horrible number. This is a decent number. This is not even the overall gross NPA 2297 crore versus 2376 crores. Again, it's a stock which has seen a lot of short positions over the last few days. So there's been some bit of covering that you've seen. Rajesh, any thoughts on this one, Karnataka Bank?
No, dear, I would not like to put any comment because it is not under my active, what I would say, so no specific comment. But I can just tell you one important thing is that don't look at number on YOY or QOQ basis, look at number on 3-year CAGR basis. Most of these banks, have reported 0% or minus 10% compounded growth in last 3 to 5 years. So they need to actually report 30, 40, 60, 70% growth to make up for the huge degrowth in last 4 years.
All right, fair point. Lata is with us. Lata, this looks like a decent number from Karnataka Bank.
Yeah, no, actually the trend is what is very positive, because after the February 12th circular, it was a fear that both the Q4, which of course for every bank was a difficult one, and the current quarter will see them spreading out their bad loans. And also because it kind of challenges borrower behavior. It said one day is a default. So it takes people time to get used to the fact that they can't pay on the 89th day and escape NPA, that from the first day when the loan is due, they are under watch. And therefore, the fear was that the inability to manage your cash flows, and especially in a small bank like Karnataka Bank, where there would be SME, MSME borrowers, will there be a problem? It looks like that has been tided over very well by Karnataka Bank. And given the new strictness with which balance sheets and loan repayments are watched by the Reserve Bank, people will not have any courage to, hoodwink, or play fast and loose with the rules. In spite of the tough February 12th circular, if the bank has been able to report lower gross NPAs and net NPAs, it's a positive. But this statement has to be qualified. We have to look at the further details as to slippages, SMA 1 and SMA 2. And only, it's quite possible that it is looking lower because there were greater write-offs also. Only by going by these numbers, you will have to say it's an improvement over previous quarter.
Okay, so that point is well taken. We right now have prima facie numbers on which you'll have to say these numbers are good. But let's look at the slippage number. Let's look at some other numbers. Let's look at the details as well. Also keep in mind, it's a stock which has underperformed a lot, really. If you look at its peers, Karnataka Bank has really done absolutely nothing, has destroyed a lot of wealth as well. And in that sense, F&O stock, there were some shorts as well. So perhaps a lot of short covering as well is what you have seen. Ashwani, technically, quick check on this stock.
See, it's at the lower end of its band, which is about 106, 108. On a good day, it can get up to 160, 165. So people who buy today, whenever, things turn around and there's a rally in small banks, you could get 160, 165. So this is a good place to buy Karnataka Bank. The stop is basically 20 bucks from here.
Okay, stop is 20 bucks from here. By the way, just keep an eye on Mindtree. It's a stock which, of course, in the past has been the flag bearer of the mid-cap IT rally. All of a sudden, there's a big move taking place on that. 1078 is what we have right now. Ashwani, mid-cap IT picking up all of a sudden.
See, IT is strong. There's no question about it. It's corrected for one day. And now, the trend is coming back. So possibly, mid-cap IT is also expecting good results. So that way, I think coming back from the lows is good because banks may have, an off day tomorrow. So that way, possibly IT could pick up. But this sort of action with a lot of sector rotation is positive.
Sure. Rajesh, actually, I'll make that my last question to you. Again, mid-cap IT, dramatic run on the stocks. Are you holding some positions in your portfolio? Would you still add more, looking at what the sector giant has delivered?
Yeah, we have turned positive on IT sector about 2 quarters back, and we have slowly added to the information technology sector. And it is a mix of large and mid what we are holding in the portfolio. So yes, it is an interesting sector, but again, it is right now the entire sector is moving up because of the currency depreciation and expected benefit because of that. But there will be difference between a real performer over a period of time. One will be able to understand, differentiate between one versus other, because not all companies are going to benefit out of this digital transformation. There are many companies again which may may go back. To 0 to 5% growth compared to 18 to 20% growth what they have reported in last year. So you need to be very, very selective. You need to be bottom up while selecting mid-cap IT.
Okay, all right, Rajesh, we'll leave it on that note then for today. Thank you very much for joining us on the show. Quick break on that note. We'll come back with more market talk and countdown to what has been an interesting day for the large cap indices. The Nifty still above 11,000, the Sensex hitting record highs. Welcome back. So it's been an up day, but it's not been a dramatically high day. You can see that graph. So I know, just kind of tapering off a little bit. Yeah. I don't know, would this then go down as a bit of a one-day rally or a one-day break?
No, I mean, see, the context is important. We already had a big rally. It's not that we didn't. From the lows, we have had a rally. Yeah. And if we close here, I think it will be among the second or third biggest close that the market would have had. I think we've only closed above 11,000 3 days, if my memory serves me right. I think and after that, the straightaway closing was about 200 points lower. So that way, on a closing basis, still a good close. The issue here is that one dichotomy is very clear and should be to everyone, is that this is a year of large caps. Last year was the year of mid caps. You could just pile on to all the mid caps and you would make money. This year, you'll have to be reluctant bulls, perhaps, on the large caps. You know, for example, Reliance just 3 or 4 days back corrected to 940. 940 to 1,060, 70 has happened in a matter of 4 days. TCS, from the time the promoter sold stake and the stock fell, has gone up 31%. That's been the power of moving TCS. Bajaj Finance. I mean, some of these moves are, you know, like the kind of move that small caps used to give or mid caps used to give. So a lot of money is, there is a lot of money. You know, I think the retail money is still flowing in, the mutual fund money is still flowing in, but I don't think the fund managers right now want to deploy that money into the mid caps and small caps. So just too scared right now. That money does not want to go into the Nifty Juniors of the world, the small caps of the world. So what is it doing? It's actually chasing some of these performing stocks. True. It's chasing TCS, it's chasing Bajaj Finance, it's chasing HDFC Bank, it's chasing HDFC. What that is doing is it's creating an illusion that all is well with the market is at all-time high, but beneath the surface, there's a bit of a problem.
I like the phrase that you often use, the cute trade. You said this is not a day when you should try cute trades. I think it's been the last 6 months when you don't even should try cute investments, because cute investments, trying to be very smart, picking up the multi-bagger, as Ashwani said, those things have not worked. You go to no-brainers, Reliance, HDFC Bank, Bajaj Finance, and that's the one thing that's worked.
And you know, right now we're saying that with the benefit of hindsight, but that's been the call for the last 3 or 4 months. You know, for example, if you would have bought TCS even, say, 2 months back, at that point also you would have asked, but it's already rallied 20%. Look at it now, it's rallied 40%. So, I mean, I completely take your point. I think this is a year of capital preservation. It's just that being in large caps has helped you not only preserve capital, but beat the market handsomely.
Oh, absolutely. Well, on that note, let's welcome in Prakash Diwan into the conversation as well. Prakash, but I will still talk to you about some of these dog stocks and whether there's any point in looking at them at all, despite the conversation I was just having with Anuj. One of these dog stocks has been UPL. I mean, I think every day people are coming, selling this stock and making money on it. The way it falls on a daily basis, down, what, 3-4% today as well. Your thoughts?
Yeah, so, you know, first and foremost, I really wonder why, whether I remind you of the dog stocks or is it that they are important enough to discuss. But now that we're talking
just
about
to look at some contra thoughts, Prakash, nothing to do with you.
Just on a lighter note. Yeah, but I take your point, because some of these stocks, the large cap stocks, haven't participated, and it's still a skew that is there, particularly in the Nifty stocks. And my sense is UPL has had its own share of and a fair share of worries and negative, you know, tailwinds. You know, they haven't yet come back from the kind of significant legal related losses that they incurred in the last financial year, and all the talk about new patents getting off, the acquisitions that they made in Brazil and stuff like that. It's not coming out. So there's a lot of money that's been put into the business, and the ROEs have just shrunk and just dipped dramatically. So it will take a lot of you know, rejuvenation on some of the product lines, and they have a lot of good products also. So it's not like beyond their means, but as and when the execution happens, market acceptance happens, market share improvement happens, you'll see the stock reviving. Otherwise, you'll probably be a laggard for some more time. But I like inherently the setup. It's just a question of how low can it go, and you'll probably have to give it some time to consolidate before you buy.
Prakash, good afternoon. I'm not making any judgments, but what about United Spirits?
I think United Spirits post, the corporate action that we saw, Anuj, this is something that has again started facing a little bit of headwinds on potential changes in the GST, norms for particularly the alcohol industry. But, if you were to play in this space, it's best to take a basket approach, take a United Spirits, take a GM Breweries, maybe a Radico Khaitan, and then you are insulated because all of them focus and cater to very different market segments which could, give some sort of growth triggers in the days to come, in spite of some negative potential news flow that could come on the GST side for ENA treatment and all. But United Spirits is not a stock that you need to be worried about, though it's much lower than, the 1400 kind of levels pre-corporate action. I would recommend a buy into this gradually into the portfolio, keep on adding, because it will significantly deliver value in the medium to long term. Yeah.
Okay, by the way, the market is off the highs, and again, just look at, for example, Karnataka Bank.
Yeah.
We're just discussing there's no follow through which is there. Of course, you want to book your profit as well. You got a big move, this short covering move, and you want to take profit home. You don't want to carry that overnight risk in this market, especially on the mid caps. If this was a large cap stock, perhaps things would have been different. As a mid cap stock, you got intraday 5 or 6%, you want to take that money home. I think that really has been the story of this market. If it was a market of 2017, the stock would have been up, I think, 10%. Today, just take money home.
And also, I think the point Lata was making, Anuj, that right now we only have 2 numbers. God knows by the time the rest of the commentary comes out tomorrow, I mean, the slippage numbers, the other numbers, if there is something negative, maybe then you don't want to take that risk.
No, that point is well taken.
Yeah.
That would have been true in 2017 also. But in 2017, regardless of that, the stock would have, ended 8-10% higher. Right now, we are in a market, especially in the broader market, where you just don't want to take that overnight risk. You just want to take your money home and say that, okay, I'll take a fresh call tomorrow. Now.
Absolutely. Prakash, just quickly call on Karnataka Bank.
No, I think I fully agree with Anuj. The kind of news flow and things that happen to some of these banks, smaller banks, and they rise against the tide, doesn't really build that kind of conviction that people are going to continue building long positions and stay on. And today, every day is a separate, theme, separate view. So I think on an intraday basis, towards 3 o'clock, if you see profit booking in most of the stocks that started off well, it's a very natural thing. So it's a buy on dips in the morning, sell on rallies by the time it's 2:30. So fully into that zone. It's only the long-term value stocks, the biggest non-Nifty participants like an Exide or maybe Ashok Leyland or something. Those are the stocks that you would need to build positions on, but not a Karnataka Bank and take it home.
Okay, quick break on that note. We'll come back and look at the close. Mark, 5 to go before the day goes out. It's been an interesting one because, I mean, for the record books, yes, you've got an all-time high on the Sensex. The Nifty is just trying to hold on to 11,000, by the way. I mean, look at the way this decline has come in the second half of the day. It's very consistent decline. Ashwani, I want to get your thoughts in on this. I mean, we still have 5 minutes to go. I don't know if we'll hold 11,000 on the index or not. But where does this leave us, really?
Well, this tells you that even quote-unquote macro good news has not helped you, close at fresh highs or close the market in any sort of strength. So it still looks like 11,000, 11,100, 150 will remain a resistance zone. So basically you are getting into some sort of a range. Now the contour of the range, the upside probably we found out today is about 11,060, 70. The downside, in my opinion, should be closer to 10,850. So possibly it's a range shift from a 10,550 to 850 to now 10,850 to about 11,050. So today we should have closed well because crude is our business, and if crude prices come off, at least the banks should have closed at the highs of the day. That way the message is not very comforting on the market.
Absolutely. There's some stocks that are still spiking. Pull up Interglobe. Interglobe is still holding on to most of its gains, still close to the highs, 5% up on Interglobe Aviation. But Mitesh, same question to you. Looking at the market's construct and this, sluggishness that's set in the second half, What would the advice be? Anyway, M&M was one of your STBT ideas. That's a sell trade that you went with. What's the thought and the advice now?
See, I think, one, we've had about 5-6 days of rally when the market has moved up nearly about 350-400 points. And also is the fact that 11,070 is the highest ever weekly closing which we have had. So in that sense, it's a weekly pivot and a previous high. So you would expect profit booking coming over here. I think, as I said, I am also expecting some kind of sideways activity for the days to come by. The lack of breadth does worry me, but it's not, as if that the trend has changed immediately on the downsides. And also today is the Bank Nifty expiry. So multiple factors playing out. But as I said, as long as we are not breaking 10,980, I think, the immediate trend is on the upside. And in case we break that, then we might just go into sideways consolidation.
Okay. Fair enough. Well, if you're talking about some of the movers and shakers, Arvind has had a decent day today as well, about 3.5% on the upside on Arvind. Prakash, just 2 minutes to go before we close out. Any fresh stocks that kind of crossed your radar last couple of days? Any new ideas?
Sure. So, this is not because of any price activity or price volume activity, but it's more to do with the structural changes that are happening in the business. And this is a company called Shoppers Stop, a very well-known name. In fact, we grew up on the retail experience with this name. What's changed is post the ownership element changing. We've seen that after the Rajas, ceded the control and ownership to the new owners, there has been a management change, and right up to the senior manager at the store level. And what I'm seeing now is the plans on expanding stores in a format which is, faster to kind of break even and become efficient on the experience, based on the experience of other retailers, is something that could be very powerful as a trigger. So, of course, it's a story in the making, but the changes are visible. You go to a store, the experience is different. The white labeling has changed to their own brands. So a lot of, those finer nuances of what retailing makes things successful is happening. They don't have groceries, which is one of the biggest areas of growth for the likes of DMart. But wherever they are present, they are making a big change in terms of their way they conduct the business, the formats. So I think Shoppers Stop could probably be a decent bet. You keep it on the radar. You may not need to buy it today or tomorrow, but whenever you have money that you want to kind of allocate to a promising mid-cap, this could probably be a good stock to start building into your portfolio.
Okay, that's an interesting one. Shoppers Stop there. Prakash's pick. We are down to the last 60 seconds, so let's recap. What's been an interesting Thursday. Yes, records broken. Yes, all-time highs. But that feeling is missing, as they say. There's something on that chart that didn't quite, left you at the high point, and that's why perhaps the conviction is slightly on the lower side. Anyhow, let's look at the large caps and see what worked today. A narrow cross-section of stocks that gain on the Nifty 68, 69 points, much of it being provided by one stock, Reliance Industries. 4% up, just off the highs of the day, but some pretty heady levels for this one as well. Then, of course, the HDFC twins did their bit, kept Reliance good company in terms of the top contributors, HDFC and HDFC Bank, both of them managing gains of about 1 to 1.5%. ICICI Bank was on the upside, IndusInd Bank was on the upside. So financials, largely speaking, were okay. I mean, we don't have too many disappointments. Yes Bank on the upside as well. Kotak Mahindra Bank just around the flat line. So this is sort of the pocket of the market that worked out. Beyond that, if I talk about the gainers, obviously the oil marketing companies, thanks to the fall in crude oil prices, all of these stocks had a decent session. So BPCL, HPCL, IOC, a lot of them are, of course, well off the morning highs, but nonetheless, gains continuing. On technology, Wipro was the outlier. Wipro has managed a 2.5% up move. HCL Tech is still positive, 1.5% on the upside. But you had to look at some losses on an Infosys, for instance, even a TCS in the negative after its mega rally yesterday. So tech, extremely mixed trends coming in over there. Some of the stocks on the losing side included a UPL, another 4% downtick on this counter. So the weakness persisted. Some selling on Bajaj Auto we've seen today, also on Mahindra and Mahindra. Vedanta has had another negative session, about 3% on the downside. Tata Motors. So that trade of sort of avoiding the global-facing stocks, that was continuing even today. Again, on the gainer side, I can cite L&T. That was a decent contributor. And, of course, the Bajaj twins. So the NBFC space was okay. Bajaj Finance and FinServ saw lots of money coming in. That's the large cap arena. Now, let me quickly move to the mid caps. The index has ended down with a cut of about 0.5%. So that's something that one has to contend with. What was down? Well, sort of a cross-section of stocks. Delta Corp losing about 5.5%. Adani Power was undoing some of the mega rally of yesterday, about 5% down there. More selling on Hathway Cable, 4% down. Strides Chasun lost about 3.5%. SAIL was down. USL has seen more selling today. United Spirits losing about 3%. PFC, NCC, Trent, these are some of the names on the downside, on the mid-cap side of the screen. Some of the mid-cap winners of the day, Interglobe Aviation for sure. Big surge towards the end of trade as well on this stock. So let's see if it can show follow-through tomorrow. 5% up. Let's pull up Jet and SpiceJet for you as well. That was the oil play that was really moving around in the market. Some other gainers included Sugar. So Dhampur and Balrampur had interesting rallies towards the end. And Arvind was a stock worth noting because Arvind managed a 3.5% up move for itself. I'll end with Karnataka Bank. The numbers that we have during market hours look pretty decent on asset quality and provisioning. We'll wait by for the details. Stock reacted positively, up about 4.5%. So that's today's close. Let's quickly take some final thoughts. Ashwani, then, what's the advice for tomorrow? What's the approach? Will you look at index stocks? Will you look at the index at all tomorrow, given the kind of session we've had today?
See, basically yesterday's low and today's high kind of becomes the new range. Basically 10,900, 11,060, 70, because this is not how a breakout should play out. A breakout needs to close at the highs of the day. Mid caps, we've seen there is no juice out there. So tomorrow you'll have to see if you get to either end, either yesterday's low or today's high. You will have to take the other side, because it does not look like great amounts of follow-through is available.
Okay. All right, gentlemen. Thank you very much for taking us through the close of what's been definitely a calendar session. Those dates and those levels will go down, but let's see if we can actually build on that or not. Time for us to take a very quick break, but don't go anywhere, because coming up next, Ashok Leyland and HPCL have joined hands to launch prepaid fuel cards. Now, is that going to work? We'll get you excerpts from our conversations with Vinod Dasari, MD of Ashok Leyland, on the other side.
Welcome back. Well, Ashok Leyland and HPCL join hands to launch prepaid fuel card. CNBC TV18's Jude Sanit spoke to Vinod Dasari of Ashok Leyland and asked him the benefits this fuel card offers to the new as well as the existing customers and the target base for this venture going ahead. Listen into that very interesting conversation.
We actually did a large study with customers to see over the life cycle of the truck, how much money is my customer spending? And we found that on an average 8x2 truck, they were spending roughly about 3 crores. Well, my trucks are on average about 25 lakhs. So I am helping the customer only on about 8% of his spend. So we started brainstorming, how can we help him on the balance 92% of the spend? If you look at the balance 92%, the biggest chunk is fuel. So if he has 10 trucks, he has no negotiating power. Yeah. We have 1 million trucks out there, or trucks and buses and LCVs and whatever combined. So we took that leverage and started negotiating with oil companies, and HPCL was a fantastic company to work with. And we came up with a scheme which is a joint card, which you can preload. And you're not an Ashok Leyland customer, but even if you're not, you can buy this card or get this card for free. And every time the driver goes to the pump, there's more than 15,000 outlets that they can go to, and just use this card. It's preloaded. The customer gets an alert saying this much was spent, and it's cashless. There is no money that the driver has to carry in his hand all the time, so it's unsafe. So and there's loyalty points, there is insurance benefits.
I understand almost all of that, but what I want to understand is how does it make you do better business? Is it the most obvious increase in customer base? Is that what you are targeting through a scheme like this?
Well, first and foremost, the customer himself gets a benefit of anywhere from 1% to 3%.
True.
So if you make the customer profitable, the customer will reward us. That's number one. And obviously, while the customer saves some money, we also get some money. So it's better business for us also.
So how many customers are you targeting going forward? I know you mentioned it is also for applicable customers and not just Ashok Leyland customers like you said just now. But how many customers are you targeting for having, opting for the service?
So Jude, each customer is one vehicle at a time. So we're easily targeting more than 1 lakh customers in the first year itself.
All right. And there's also an existing customer base that can make use of the card itself. What is the strategy to sell it to the customers that you have at the moment existing?
Well, the existing customers, we will do a campaign to address. I mean, we'll already started showcasing it to many customers and the response was fabulous. This is the first time a commercial vehicle company is actually looking at our overall spend, not just as selling us vehicles and leaving us to figure out how to control those expenditure. So we are partnering with them to find out those expenses, and if I can do something on the vehicle to improve, I'll do. We make the most fuel efficient vehicles, but beyond that it still consumes fuel.
Sure.
So how do I help him? Tires, batteries, other things. So we will continue to come up with more and more things.
1 lakh in the first year is what you say you're targeting. What is the potential to scale up, and what will that scale up be like?
10 lakhs maybe, easily. So lots of opportunity.
Okay, moving on then. India's quest for a dedicated data protection law continues, with the Justice Sri Krishna Committee likely to submit its recommendations for a draft bill before the end of the month. But the big question is, can this law have the same rules for the private players and the government? CNBC TV18's Kevin Lee finds out in the 4th installment of Data Wars, a CNBC TV18 special series.
Earlier this year, on the 25th of May, the European Union's new landmark data protection law, the GDPR, came into effect with the intention to protect citizens' data and penalize companies who are misusing this data. However, that same week, the European Commission accidentally leaked the personal data of hundreds of European citizens, but faced no penalties under GDPR. So is there a level playing field for the government and private companies when it comes to data protection? GDPR's intentions to put citizens in charge of their data and penalize companies misusing this data were hailed across the world, and it is widely expected that new data protection laws across countries, including India, will borrow heavily from the legislation. Larger advertising and marketing agencies, a big pillar in the data ecosystem, have recognized this and begun efforts to become future ready.
Some of the advertisers or the publishers may have gone overboard over the last few years in terms of using data to target people, and we've had breaches where Cambridge Analytica and some of the companies have had misused the information that they got from publishers like Facebook. But I think that is sort of in the past. I think with GDPR coming in, I think people are going to become more sensitive.
But while hefty penalties may be enough to keep companies in check, holding the government accountable may prove to be more challenging.
When it comes to public sector, which is government and government's enterprises, this incentive is a little weak, because ultimately the cost is borne by the taxpayer or the government, which is the shareholder in these public sector enterprises. So there I think the approach should be more preventive and not so much, I mean, you can impose penalties, but that may not have the kind of effect it has in private firms.
It is this challenge that the Justice Sri Krishna-led committee will have to grapple with as it prepares its draft data protection law. And with initial reports coming in that the law may not apply retrospectively to data collection for Aadhaar, the assumption is that Indian citizens may have to wait for a few years before they have access to the right to be forgotten.
Suppose a right like this is there, then you will have to create exemptions from this right also, because there are systems in which the right to be forgotten should not be there. For example, the tax system. Tax system has a lot of your information which is required even after a few years of us giving that information to the revenue department. So similarly, in national security, there can be exemptions. Similarly, there can be exemption for national identification also.
because it's a form of identification. Like you have PAN card, you can have Aadhaar card. They can be exemptions for that. But each exemption has to be properly thought through so that you know that there is strong grounds for giving this exemption.
And while we'll have to wait for the report from that committee to come out before we know what rights we have and don't have, the Justice Sri Krishna Committee isn't the only body looking into data protection in India. The country's central bank has something to say on the matter as well. To find out more, tune in tomorrow. In Mumbai, Kevin Lee.
Okay, it's time now to take a short breather on the show, but the big headline today came in from the world of commodities, with the crude slipping 7%, the biggest fall we have seen in the last 2 years. Manisha Gupta will join in on the other side to tell us how the trends look like in the space of commodity and currency.
Welcome back, and let's chat commodities now, which actually have seen a bit of an uptick coming in today after the kind of slide that we saw yesterday. For the crude oil prices, it was 7% down for Brent and 5% down for the US crude, but we have seen them claw back today. So nearly a percentage point of gain, as you can see, for both the varieties. Brent, of course, seems to be getting it quite better. The metal space also has been under pressure, and we have seen buying a bit into that one as well today. But let's get on to chat on that. Paul Bartolomeo of S&P Global Platts on his sense on all of that space. Paul, hi, good to have you. The complete sell-off that the metal space has seen in last couple of months, and especially in last week, 10 days, has been on the back of US-China trade wars. What are you reading of the event and the impact on the metal prices?
I think the biggest impact of the all the talk around the US-China trade war is that it actually sort of freaks out the market a little bit. It just causes a lot of uncertainty. Buyers hold off a bit from making purchases when they're a bit uncertain about the market direction. And also because China is increasingly a sentiment-driven market where there's a lot of participation in steel and raw materials futures. That has a flow-on effect into the physical markets. But what we've seen previously, when the US first announced the Section 232 measures, is that the market sort of gets the jitters for a few days. Prices tend to go down, and then after a few days, it sort of gets back to normal again. But everything's happening so fast at the moment, with the US talking about putting in sanctions, or not sanctions, but import tariffs rather, on auto, white goods, and all this sort of tit for tat sort of behaviour going on. So it's the fact it just causes that sort of uncertainty that can have some downwards pressure on prices.
Well, absolutely. And we have seen the downward pressure come in for many of those metals, Paul. Copper and zinc prices nearly at a one-year lows. How much of a further risk to downside would you see, especially for these couple of metals?
I mean, the fundamentals are sort of, fairly solid. If you look at China's, housing section, which uses a lot of copper, it's still very, very robust. If you look at fixed asset investment in property, construction, and infrastructure, it's all fairly strong. It's all in growth territory, not quite as strong as last year, but it's still robust. So I think downstream demand is still looking fairly healthy for most metals.
One metal that continues to shine bright really has been the steel prices, Paul, trading at a 10-month highs even today. The China pollution crackdown has led to output concerns onto that one. How are you reading on those numbers?
Yeah, well, the steel market is very, very interesting at the moment in China, because the government are implementing sort of endless series of environmental checks and inspections, and they're curbing steel output. Sometimes it's very, very targeted, very specific. It might only apply to one particular province or one particular city in that province for maybe just a week. They'll be told they've got to reduce their production by 50%. So they're constantly monitoring, constantly tweaking steel production in a bid to try and meet their environmental targets. But the big story really is that despite all of this, despite all of these measures to improve the environment and to try and get, which they're doing through reducing steel production, China's producing more steel than ever before. It produced an annualized 955 million tons a year in May, which was way up on think about up 8% on the full year total in 2017. So it's all part of China's supply side reform agenda. So what you're getting is you're probably getting at least the same amount of production, if not more, but coming from fewer, more efficient producers. And it's really the small, inefficient, polluting players, not just in steel, but across the industrial sector in general in China, that are sort of getting phased out. Another interesting point too is that having to meet all these environmental targets and measures is actually making the cost of producing steel is making it more expensive. It's adding, we've estimated, around another $40 a ton to the price of producing steel. That has to be passed on to the end consumer. So that's just another reason why we see steel prices being supported over the second half of this year.
Paul, also, the steel ingredients like iron ore and nickel also have done quite well today. What is your sense? Because while we have seen the nickel prices continue to follow the stainless steel prices, iron ore really seems to be having a mind of its own.
Yeah, I mean, iron ore is very interesting, really, because it seems to become a little bit sort of almost decoupled from steel prices. So whereas in the past, if steel prices went up, then iron ore prices equally went up. Now, the major Platts IODEX 62% benchmark has been very range bound in the sort of kind of mid-60s type region for much of this year. Much of the activity is happening around some of the kind of impurities and spreads for different products, but that core benchmark has been fairly stable, notwithstanding some of the kind of volatility we've been seeing in some of the higher steel prices. And nickel's obviously a major ingredient in stainless steel prices, so that's can expected to be reasonably well supported as well.
Fair point. Paul, also, as we stand today, would you say that all the bad news has been factored in, whether it is the strong US dollar or the demand concerns or the US and China trade concerns, or do we have further downward risk from here?
Yeah, well, I mean, the whole, I guess, trade war in inverted commas saga is very much is an ongoing topic at the moment. With there are announcements from out of the US or China or the EU on an almost daily basis, and there's been huge numbers mentioned, involving billions and billions of dollars worth of imports and exports. So I think while you've got that market uncertainty hanging around, it is going to kind of cause some jitters. So it's going to add to some of the volatility around some metals prices. But if you just sort of take that away and you look at some of the fundamentals in China, which is obviously the biggest consumer of most of these metals, it's still very, very it's very sound. It's very robust. Most of the end user segments, manufacturing, property, infrastructure, they're all still performing fairly strongly. So you'll get some volatility, of course, but I think we're not expecting the prices to sort of drop off a cliff or anything like that, because they're well supported on the demand side in China.
Paul, so which metal would you see responding higher, faster when we see things stabilize a bit? Where do you see better fundamentals really?
Well, we still see, I guess, steel being a very strong performer. I mean, it hasn't, been subject to some of the. Of course, the price fluctuates, but generally speaking, it's been a very strong performer now. We're almost going into the third year. I mean, the market recovery occurred in 2016. Last year was a very positive year. This year is a very positive year. Like if you talk to Indian steel makers, Chinese steel makers, or European, they're all fairly positive about the state of the steel price. So we'd expect that to be a fairly good performer for the rest of this year.
All right, so the uncertainty is expected to go on, but steel could really emerge as a winner there. Paul, thank you so much for joining us and giving us a sense on the metal sector. Joining us also on the show is T. Gnansekar of Comtrends. Now, Gnansekar, hi. Metals, of course, has been, an important area because we have seen a lot of volatile moves coming on for this one. What is your sense on the way we stand today? The steel, of course, is emerging as a winner. Would you also look at the other metals taking their cues from steel?
I think so, Manisha, because, as your guest rightly said, things are more or less factored in, and it's kind of overdone the way we have seen the fall, and it's making an yearly low. So, technically, I think there is going to be a recovery anytime soon. But it would all depend on the news flows that, will continue in the coming months or coming weeks on the trade war situation. But I guess the market will get immune to it somewhere down the line, and would just start focusing back on the trade and start focusing back on fundamentals, which seems to be robust. So I believe the downside is going to be kind of limited from here. And I sort of expect some recovery from here, and I think a big list inclusive of copper, nickel, zinc, lead, all of them could see a decent recovery of 5 to 7% or even 10% in the coming weeks.
All right, that's quite a number really. So would you say that the bottom has been made for the base metal prices right now, or would you give it a longer time, a further downward risk and then perhaps some accumulation?
Well, the honest answer is I wish I knew, Manisha, but the point is that we have a lot of news flows which are essentially going to dominate prices going forward. So technically I don't see a bottom, but I think there's a possibility that we're in an intermediate bottom at least.
All right. How would you look at the crude oil prices then? Because volatility is the only certainty there. With that kind of expression, how are you going to trade?
Yeah, like you said, I think it's going to be tough. Having stops is extremely important. You can't take a medium-term to long-term view. But to me, I think the overall situation right now is building up in such a way that I think the US is trying to put pressure on OPEC to increase supplies. That might drag prices lower, and people who've been long at the higher levels could start exiting positions. But there's fairly strong support near $70. And there's a lot of positives that can again take markets to higher levels. So I'm not giving up the bullish view, and I think around $69.70 is going to be a very, very strong level and should hold and move up back towards $78, $80.
All right, so sell calls coming from you today, but buy calls couldn't be far away is what you're telling us. Thank you so much, Gnansekar, for joining us with your strategies. And with that, that's all the time that we have on this edition of Closing Bell. Thank you for watching.